Good morning, everybody. It's Steve Brown from Mirae Securities, Mirae Asset Live. Joining us this morning, we have Mr. Andrew Williamson-Jones, the founder and CIO of Halo. Andrew, pleasure to have you this morning.
It's good to be here. Thank you. Thank you for having me.
Thank you. Now, you've been with, in the past, companies like BlackRock for almost a decade. Yep. You've set up your own fund, headquartered in London, investing in ASEAN ex-Singapore, and you've been specializing in investing in this region since about 2017, successfully building out the fund, nicely well over 100 million US equivalent AUM now, and consumer story focus in your fund.
Very much so, yeah.
I'll let you just take the microphone, so to speak, and let us know why you set up Halo.
Okay. As I say, I was at BlackRock at the time, and part of my role there was to look at China. And it's a time when I was spending a lot of time looking at the commodity sectors. And this was in 2011 and 12, and obviously China had just gone through its commodity, I suppose, intensive boom post the financial crisis, and obviously they opened the fiscal taps and there was a huge amount going on. But I also sort of started to think about and look at was I suppose they were going to come off that, and the next stage in China's development was to move away from heavy reliance or heavy investment in infrastructure and into consumption. And I was thinking at the time that perhaps, and certainly when I was running global money there at BlackRock, that was actually starting to have more investments in the China theme, but within the consumption space, and I really wanted to play that. And so I was thinking, well, why not go and set up a fund that would very much play into not just the China consumption story, but the Asian consumption story.
Okay. And you successfully headhunted some of your own ex-BlackRock colleagues as well. Palvia Bahia has joined you as well, and she was with the firm for several years also.
Yes.
So what, combined with your talents, makes your fund different to peers looking at Asia?
Taking a step back and thinking about Asia, we're sort of thinking, when we speak to investors and most people think about Asia, they're typically thinking about the China, the Indias, the Vietnams, the Philippines of this world. It's the developing, the fast-growing countries. And actually, people think perhaps less of the Korea, Taiwan, Singapore, and Hong Kongs, which are developed. And so our thinking here is, if people, particularly when they want to invest in Asia, they want exposure to that emerging growth. That's why people invest in these countries, certainly when you're thinking from a developed country perspective. And so we thought, actually, for this fund, why not just purely invest in those fast-growing developing countries and strip out what MSCI may class as developing, which is obviously Korea and Taiwan as well, and then MSCI Asia includes Hong Kong and Singapore. We said, okay, let's just forget about all those. They're not relevant here. They're more akin to Europe and the US and Japan. They're developed economies. And so purely focus on developing. And to be fair, we haven't really come across anyone who sort of looks at Asia in that way. And then on top of that is to make it consumption focused. So the reason behind that was that you get typically the GDP of these countries is real terms is 5, 6, 7%. In nominal terms, obviously today it may be a bit faster because we've got slightly faster inflation. In normal terms, the GDP could be 8, 9, 10%. And then saying, what is the biggest driver of that GDP growth? And you look across all these countries, typically 60, 70% of the GDP growth comes from consumption. So we thought, well, why not then set up a fund that plays into the biggest driver, being consumer stocks?
Got it.
And that's what we believe what makes us different. And so far, people ask us actually, do you know of anyone else who's doing the same way as you? And the answer is no, we haven't come across anyone who's doing it exactly the way we're doing it.
Okay, so that leads me on to my next question. Investment philosophy and approach. If you can get into some of the specifics and into some of the countries that you're investing in, such as Vietnam and Philippines. Yeah.
So the investment philosophy behind it, as I say, talk about this nominal GDP growth, and behind that being consumption is the biggest part of it. And so we want to play that consumption growth. And typically, as countries go through different, GDP per capita, there are certain sectors or industries which grow faster than the nominal GDP. Typically, people talk about cars, for instance. Typically, cars takes off at GDP per capita of 3,000. While in China, obviously, the GDP per capita today is $10,000, $12,000. As it is today, it's more about education, healthcare, tourism that really takes off at that sort of level. And so we will identify these industries within these countries where we think there is a sort of step change and acceleration in consumption. And then the idea that behind that is then to go down and focus on, once we identify the industries, to try and identify the winners within those industries in those countries that are going to benefit from this structural growth. So if the underlying growth is 6, 7, 8%, hopefully the companies we are investing in can grow at 12 to 15% or faster over a number of years.
So the businesses that you're looking to invest in are the ones that have the high consumer disposable income, discretionary spend opportunity. In Vietnam, you're invested in P&J, for instance. And the companies, therefore, that you would look at to avoid investing in, if I can ask that style of question?
Yeah, the ones we look for, as you say, the structural growth, it's not just a fad now, but also they have pricing power is the key point to it. And so in the current inflationary environment, which is obviously very topical at the moment, these companies must have the ability to pass on that. And the focus is more into middle, upper income. So it's not really mass consumption. And obviously that's playing quite well in the current environment because typically we're finding in all the countries, whether it's the Philippines, Vietnam, China, India, they're all coming through saying the upper middle class is having a fairly good COVID experience. In a sense, they're not seeing a detriment to their income, whilst you find the masses are suffering more. But what typically we want to avoid, we are very much in consumption, the pricing power and the power of compounding. And what we generally don't like is very cyclical sectors. So this can be, at the moment, it can be commodities. Yes, they got strong pricing at the moment, but typically that will fade at some point in time. They're very cyclical in nature. We don't own a Samsung or a TSMC. To us, they are global companies. They're quoted in Asia, but they're global in nature in terms of they're selling globally. It's not really based on developing Asia. And also the pricing power comes and goes. So it's typically commodities, heavy industry, utilities, telecoms, another sector that generally doesn't have great pricing power. You get more data and more voice calls for the same price every year, and that's not something we're particularly interested in.
So you prefer consumer discretionary like a P&J to a consumer staple like your Masan consumer?
Yes. We would do, and the reason behind that is when you, and I suppose Vin and Milk actually is a classic example in Vietnam where it's really only growing as fast as the GDP. It's 5-6% top line growth. It's got what it can. It can't really grow fast. Well, if you invest in discretionary stocks, as people get more wealthy, they have more discretionary income and they can spend it on other things and enjoyment and services. So the philosophy actually behind the funds, we have a lot more consumer discretionary and that consumer discretionary is fairly service orientated as well rather than consumer staples. There's only so much milk or yogurt you can consume in a day without getting too fat. So even though your GDP goes up, you're not actually spending that much more.
And in ASEAN, ex-Singapore, your ranking of your preferred countries to invest in.
Where is it today?
Where is it today?
Well, I suppose perhaps one of the reasons I'm here in Vietnam today, dare I say that, it probably ranks as number one. That's more to do with the fundamentals of the country. Obviously, it's a young population. The GDP growth is very strong. Behind that is foreign direct investment, which is, again, as percentage of GDP is probably the highest in ASEAN as it currently stands. It has a current account surplus. Which is quite unique among a lot of ASEAN countries who don't. Admittedly, Malaysia and Indonesia today with a commodity boom are running surpluses just in Indonesia. But we think structurally Vietnam with the foreign direct investment and actually the education, the workforce here and the go-getting culture appeals to us more than perhaps other countries in the ASEAN space. That's number one. Right now, Indonesia perhaps is number two, given the commodities and what's going on here, and Philippines will probably be number three.
Okay, and so Vietnam number one, Indonesia, then the Philippines in that order. What stocks do you own in Vietnam? I've touched on P&J. and then just a brief summation on why.
Okay. Just a sort of focus on PNJ as an example. Obviously, we own other stocks in Vietnam. We'll talk about it as we can, but let's just focus on PNJ. This is a company which obviously is the market leader in its field. It dominates the modern trade. There are others, but obviously in terms of their size, they're a lot more insignificant than PNJ itself. On top of that, when we look at what attracts us first, is we've seen in other markets, more developed markets, what the jewelry space can do as the economy takes off. Obviously, we can look at China as a prime example. Back in the low 2000s, their GDP was $3,000 per capita, and there's companies like Chow Tai Fook, which is in China, which is one of the jewelry retailers, and you saw what they did over a 10 to 15 year period as jewelry really takes off. And so it's great to find a company like PNJ here that is in a similar mold. It has the market share, it has the pricing power, and it has the ability to expand across the nation.
Sure. And it's also got your market cap criteria. It's even in the volatility of today, it's market cap still comfortably over $1 billion US.
It is indeed.
And it's the dominant market player in its sector, isn't it?
So. It is. And I would say it has the pricing power. It's one of those in the sense when the price of gold goes up, actually it becomes more attractive to consumers as a perhaps even as a store of value, as well as looking more beautiful if you can put on the diamond stud earrings.
And your take on Vietnam, there's certain sectors with foreign ownership limit, FOL restrictions, banks capped at 30%. Some of the stocks that you're talking about, Vinamilk's approved to 100% now. If you could change anything from a foreign investor's perspective and point of view, what would it be?
We would love to see Vietnam get into the MSCI Emerging Market Index. Obviously, it's been a very slow journey. We're not there yet. And obviously, one of those barriers is the foreign ownership limits that obviously the government here wishes to, at the moment, to maintain. And because we feel when you look at the growth of the companies and the P multiples they're on today, they are a lot lower than perhaps what they should be. And we think that's principally down to being frontier / foreign ownership limits. Because obviously when we want to buy some of these stocks, we're having to pay a 7% premium, obviously to be able to trade on the market. That indicates obviously certainly institutional investors like ourselves see value in these stocks. We're willing to pay that sort of premium on day one. But actually when you compare the banking stocks here, which have returns on equity of sort of 20%, which is probably the highest, is the highest in the whole of ASEAN, and up there and beating India, and you look at the potential and the growth rates, and these guys are compounding at some cases north of 20% a year. The multiples you would expect them to be on would be 2 to 3 times book at least, and perhaps a P of 15, 20 times. But actually today, they're on 1.1 times book, 1.2 times book on single digit P multiples. And so we think a lot of that is down to the barrier of foreigners not effectively being allowed to own them, and that, in that sense, not being valued perhaps as they should be. So we would love the foreign ownership limit to be removed.
Or at least relaxed a bit more.
Or at least relaxed.
Like banks from 30 to 49%.
Yeah,
perhaps.
exactly. And that's probably maybe enough. It'd be interesting to see if you did relax it to 49, how much the rush of
a wall of money
would come into them to take it straight back up to 49%.
Yeah.
And I suppose that wall of money may not come while it's still classed as a frontier market. But if you move into emerging markets, that wall of money is going to come. And so we hope in the next 2 to 3 years that actually Vietnam will be able to progress to that.
It's very interesting because South Korea is still classified as an emerging market.
Yeah, and it shouldn't be.
So what you've just been discussing, it's a very complicated thing that's been going on since I've been in Vietnam for 9 years, and hopefully within the next few years, Vietnam will advance into the emerging market status, because its weighting in frontier is immense, a deep double-digit percentage of allocation for everyone. So how do you see now the outlook for Vietnam for the rest of 2022, US Fed tightening, so corporate bonds will be becoming more expensive for issuers domestically if they try to issue paper on the international market has historically in recent years been through the SGX in Singapore, and for 2023?
That's crystal ball. I suppose we come back to the fundamentals today. So obviously the Fed is tightening in the US, interest rates are going up, and obviously speculation they're going to have to do 75 basis points move perhaps in the next month or two. It's because inflation is obviously starting to prove very sticky. Obviously inflation here is not in the same degree. The official numbers are some are just north of 2%, which in this great scheme of things is very low. But obviously I would say that's probably going to rise from here. Obviously you had the benefit of pork prices coming down, rice prices being broadly stable, but like it is they're on the way up. And interest rates here may have to rise a bit. But I don't think it's anything like the degree you're seeing elsewhere. And so we kind of feel here, in terms of when we look at the economy, it's very manageable. Even if interest rates do rise 50, 100 basis points, 150 basis points here, given the growth rate of Vietnam growing at 6-7% a year, that isn't really going to curtail that. There's obviously a lot of foreign direct investment that's coming into the country. We've seen it even during the COVID periods, and obviously now the economy is opening up. That was likely to continue to grow. And so with a strong foreign direct investment, the current account surplus, and obviously the government is putting a large stimulus package in through the economy this year. I've seen some sort of numbers, some people talking about growth rates of 6 and 6.5 this year, but I actually think that's probably a bit conservative. I think it may well come in ahead of that.
Really?
Yeah.
Wow.
So we are, as you say, positive.
So you're very bullish.
We're bullish, but obviously going into next year, if I suppose there's the global slowdown, does the US go into recession? Now, obviously, Vietnam is one of the large exporters to Europe and the US. So the only caveat to this, if I put it through, is that the export demand may be more muted next year. And so in that sense, this may have a knock-on impact, obviously, to Vietnam being a big exporter.
But if you're kind of looking at the internal market, the consumer discretionary, there's still scope for the stocks in your portfolio to sustain themselves because it's a lot of the FDI factory operators who are exporting their products. The internal market being generated in Vietnam is still on the up and up.
Oh, very much. I mean, just wage growth this year. I've been speaking to companies this week. Most people are saying it's 7-8% wage growth going on this year. And I would anticipate to be something similar next year. And when you're getting wage growth of those sort of levels, and inflation is, if it does stay at 2 to 3%, you've got proper real wage growth and wealth creation going on. So the actual consumption in Vietnam should remain quite robust. And this is why when we invest in the countries, typically we're investing anyway on a 3 to 5 year view when we buy these companies. We don't do it for 3 months or 6 months. So the structural growth and the consumption growth and wage growth that's going on here and the wealth effect that's happening, obviously rising property prices as well, that certainly does help. We expect it to remain fairly robust over the next 18 months.
This is all before, the stimulus bill starts to get dispersed. And,
exactly.
And then we had Tim Evans on, the CEO of HSBC Vietnam as well earlier on, and he was talking about his company at the environmentally friendly loan disbursement level, looking at dispersing up to 12 billion US equivalent between now and 2030 in green loan financing for corporates in Vietnam if they can support them in that area. Last question, therefore. Are you looking at any of the ESG issues in Vietnam as part of your investment mix? Are you looking at some of the companies that are getting into, say, solar power, hydro, or is it primarily still focused in the consumer discretionary?
No, when we set up our fund, people, and we expect to stick to your remit, so to speak.
Yes.
And we have looked into, we actually do own, in another country, we own a waste to energy company.
Okay.
And the reason behind that is obviously the more you consume, the more waste you have.
Got it.
And so it is a play, a second derivative play, dare I say, on consumption. So it's a green energy, and in that sense, it is a play on the consumption growth. We've taken a view when we look at solar or wind or other alternatives like that. It's probably one step too far removed to say it's consumption in its direct consumption impact per
Got
se.
it. Got it.
So no, we haven't gone down the infrastructure because we class it as effectively infrastructure,
Yeah.
and it's not something that's really part of our remit.
Sure. Okay, but the banks you like tier 1, tier 2. Do you have any particular favourites at the moment?
We like. I mean, banks again. We like the retail focused banks, especially say in Vietnam as well. The growth rates that we mentioned earlier, they're growing very well. The lending growth has been very strong. The demand for loans has been very strong, and so the likes of Techcom Bank or VPB or VIB, the sort of classic, more retail-focused banks that are out there with high ROEs and at the moment very cheap valuations. It's something we're looking at. Yes, we do own Techcom Bank, and we are looking at the other banks as well, perhaps to increase our exposure further in Vietnam. And one of the areas we're thinking about is the financial sector. Certainly the ones that are involved in mortgages, car loans, credit cards. It's there, and bank assurance. It's the things that the classic middle class person consumes, touches, uses, and spends their money.
Sure. Okay. Andrew, thank you so much for popping in and having a chat to Mirae Asset, and hope to catch up with you on your next travels to Vietnam and when you're in ASEAN. Andrew Williamson-Jones, thank you. Steve Brown from Mirae Asset Securities. Have a good day.